Got a very special guest on with us this morning, Michael Gray, who's written a number of books. His latest is the Real Estate Tax Handbook. That was the invitation we sent out, and we had tremendous response to that. Of course, it is that time of year. It is at the end of 2014, and people at that time start thinking about their taxes and how they may structure themselves, not just for this past year, but in many cases going forward into 2015. And, you know, we do these webinars typically twice a week. We talk a lot about different things in the real estate world. We've been doing this for about 5 years now. Typically, I have a guest on. And one of the questions I do get asked a lot is about taxes. You know, what are the tax benefits to owning residential real estate? And the answer I always have to give is that I'm not a tax professional, and so therefore I'm not qualified to give tax advice. So I won't do that. I'll typically just defer and say, you know, get a hold of your tax accountant, get a hold of your tax preparer, your financial planner, and talk to them about the benefits of owning real estate and the tax benefits that apply to that. So today is really kind of cool. It's great that Michael agreed to be here. Michael, welcome you here today. We'll get to Michael in a few minutes. I'm going to do a short presentation. Just talk about a few things that are going on in the real estate world, some things that have changed in 2014, what we might look towards in 2015. For those of you that don't know me, my name is Charlie Castor. I've been hosting these webinars now since I said 2009. I also host a real estate talk show on Real Estate Radio Live. That's carried on the Wall Street Radio Network on Thursdays from 2 to 3 o'clock. If you'd like to listen in live, you can go to kdow.biz and listen to us live on Thursdays. Or you can always just contact me and we can give you a copy of the podcast. Some shows that we've recently done, if you'd like to listen to some of these are pretty interesting. I picked the ones I thought were most relevant for the sort of the smaller real estate investor. October 2nd, I had Jason Gautreaux from National Mortgage on. They are a lender, and they do lend for investment real estate. They're one of the few that I've found that is a non-recourse lending institution, but they don't charge exorbitant fees, and their interest rates are extremely friendly, up to 30-year loans. Excellent interview with Jason Gautreaux and his partner, Michael Sorensen. October 16th, I had Dan Noble on from Summit Assets Group. Many of you know Dan, and many of you were invited to today's webinar by Dan with Summit Assets Group. I do a lot of work with Lori and Dan. Awesome interview, I thought. World of knowledge. They've been doing investment real estate since prior to the crash of '08. They go back actually to 2000 together. October 23rd, I had Ryan Pullman in now. You probably don't know who Ryan is. Ryan is the owner of Buy Property Direct. They are the largest seller of investment real estate in the United States. They project sales of about $280 million in 2015. That's a pretty impressive number. I could have interviewed Ryan for 2 hours. I got more out of him in 1 hour. I would encourage you to listen to that podcast. December 5th, which was just last week, I had Ray Bartle in. Why did I invite Ray Bartle? Ray is a large investor in Missouri. Now, why did I do that? Because of the unfortunate events in Ferguson, in St. Louis, in Kansas City. People were asking questions about that market, what was going on in Missouri. I knew Ray. I do some work with him through a couple of hedge funds in that market. So I had him in last week. Excellent interview. And then again, coming up December 18th, we'll have Michael Gray, our guest today. So I just want to talk a little bit about what's going on in 2014 in the investment real estate market. And there's a lot of things that have changed in 2014 from 2013. And the first thing is that inventory has decreased. Clearly, the market's rebounded. In most markets, you see it a little more difficult to identify inventory. Now, that is market dependent. Some markets still have lots of available inventory, but some are shallow with inventory as well. Prices continue to rise to the point where there's bubbles in some market. If you live in California, you may or may not know that this is probably the most overpriced real estate in the United States. 8 of the top 10 most overvalued markets in the United States are in California. And it goes all the way from north to south. It goes from San Francisco to Santa Barbara County, to Los Angeles County, to Orange County, to Riverside County, to San Diego County, to Ventura County, all across California. Those are considered to be the most overpriced real estate in the market, which is why you don't see a lot of investment dollars, in particular with the hedge funds in California. Arizona and Nevada, these are 2 states that went way down, Phoenix and Las Vegas in particular, and then went way up. And so those markets there in particular are places where it's very difficult to get inventory, and you're probably looking at some bubbles in those markets there, which is, again, why most of the institutional buyers are staying out of those markets. In 2014, hedge funds stopped buying in bulk. Now, most of you know that have been on my webinars or heard my radio shows, you know that I work with hedge funds. I work with 4 different funds across the country. What does this mean to you, and why do I point this out? It used to be in 2012 and 13 in particular, the hedge funds would buy everything. If there was a group of 50 properties available in a certain market in one package with one seller, they'd buy it. They stopped doing that in 2014. They're still buying in bulk, but they're not buying the bulk lists and tapes, which means they're cherry picking. So for example, if I present to a fund 100 properties in a package, they'll buy 70 of them. And what are they walking by? They're walking by this stuff that's been vacant for a number of years, that isn't rehabbed, that has extensive work that's needed. This is the type of advice I've been giving the smaller investor for almost 5 years now. Stay away from the stuff that isn't fully rehabbed, rented, and turnkey. Don't get into that speculative stuff where I can buy this house for $100,000, put $50,000 into it, and it's going to be worth $250,000. There's gambles involved in that. If you want to talk to me, I want most of my time today to be allotted for Michael, but if you want to talk about why that's dangerous, we can do that. But the bottom line is the hedge funds stopped buying for that very reason. Specialized REO groups have dwindled. What is that? What's a specialized REO group? Those are the companies that came to being in 2008 and 9 when the market sort of crashed. And these groups sort of got in the market, got involved with wholesalers around the country, would buy real estate, fix it up, and then sell it to you, the investor. And that's okay because there's some value to that. But there are a few of those companies now because a lot of these groups are buying direct. So they're buying direct from the selling parties, like a Summit Assets group who buys the real estate and then sells it. They don't go through a bunch of third parties. So those specialized REO groups have really sort of dwindled in the last, well, in the last 12 months in particular. I was sponsoring a number of those specialized REO groups on these webinars for a number of years. And if you noticed, you don't see many invites for that anymore. It's primarily buying direct from the selling parties now. But the biggest single change in 2014 by far, nothing was even close, was the fact that you can now get financing. I mentioned it at the top of the broadcast that the number one question that I was asked the last 5 years was about taxes, and that's true. But the second most asked question absolutely was about financing. You know, Charlie, do you have financing available? These are great properties, great returns. What about financing? And the number one answer was there is no financing. There's no non-recourse lender out there willing to loan in this space. I mean, it was hard enough to get a loan for a house you were going to buy, right? To qualify, lending got tough because of what happened in 08, 09. Actually, what happened in 2004 to 2008 was when the problem was created. It just came to a head in 2008 and 9. But financing was almost non-existent. There was non-recourse lenders, but there was big upfront fees. There was big interest rates. Much of it looked like hard money loans. It was not attractive at all. Now, in 2014, that's changed. The last 6 months in particular, smaller lenders are offering to finance in select markets on select properties. We can talk about that. If you'd like to get information about that, I'll show you a couple of examples here in a few slides. B2R Finance, if you don't know who that is, Blackstone Real Estate, if you want to Google them, is the largest owner of single-family homes in America. They own right around 50,000 homes across the United States. In late 2013, about September, October of last year, they launched a division called B2R Financing. What they do is, if you own 3 properties or 4 properties, they'll loan against that equity in those properties and give you cash to go buy more. And then once you own those, they let those season for 6 months, and they'll loan you more, and you go buy more. So it enables you to take a portfolio of 3 or 5 or 10 properties to 10 or 15 or 30 properties. Extremely friendly rates, extremely attractive lending platform. I have a couple clients working with B2R now. And then Security National Mortgage, I mentioned Jason Gautreaux at the top. I interviewed him early October, him and Michael Sorensen. Again, he is working with a couple of clients of mine. Extremely friendly rates. They're up to 30-year loans. If you've got a bankruptcy or you've had a foreclosed property in the last 3 years, they can still finance you. But these are 3 different forms of financing that is 100% different than what you saw a year ago now. A year ago now, I was still saying, I don't recommend any non-recourse lender. Now there's a number of places that I can direct you to if you're looking to do some financing. The Asian investors are absolutely in the market. We're actually dealing with a Chinese firm right now. They're looking to come into this United States market very heavily. About a year ago, we know that a group of Chinese invested $500 million in Blackstone, who I just mentioned. We know that they are coming into this market in a very big way. I got this article off CNBC in late October, and it talked about the Asian investor coming into the market, and it cited 2 reasons. Why is Asian capital, so aggressive buying single-family properties in America? And it cited 2 reasons, and these are 2 reasons that you should consider when you're looking to buy, but also, interestingly, this is exactly why the hedge fund guys buy. So here's the two reasons they cite. Number one, there's too much capital chasing too few investment opportunities. That's the case for both asset classes, real estate, stocks, and bonds. A lot of money out there. Most of you that know the finance world, you know that after the global recession of 2008, 9, 10, 11, and probably even 12, 13, a lot of money was sitting on the sidelines. That money was always, it wasn't like the world went broke. It was that the smart money sat on the sidelines and let this whole thing shake out. Well, now that money's freeing up, and they're trying to find places to put it. Second reason is real estate's become a particularly enticing investment globally as investors search for yield in relation to risk. And I want you to draw your attention to that. It's very important. Whenever you talk to a hedge fund buyer and you say, why are you investing in real estate in America? They all give you a little bit of a different version of the same story, but the one commonality amongst all the hedge fund guys is they say, because the yields are good and the risk is lower than the market or any other paper stock you can invest in. You can buy an asset that's under market value. It's going to appreciate in value because history tells us the market will always cycle back up, which is what you're seeing today. It's a commodity. It's a house sitting on a piece of land that you own outright, and you have the best rental market in America's history right now today due to the fact that so many Americans lost their homes. So you have so many Americans who are no longer homeowners but renters. So you combine these factors. It's a commodity. It's going to yield a nice return. It's going to go up in value. You've got a great rental market. And you can get prices at historically low levels. So when they say it's the best investment for yield in relationship to risk, that's exactly what a hedge fund will tell you. It's the best investment in America today. It's a tangible asset. It's not a stock. It's not going to go away overnight. It's going to hold its value, particularly if you buy it under market value. This is the reason why you're seeing now the Asian money bombarding the American economy looking for real estate. And yeah, so are hedge funds becoming the market in real estate? Well, a couple of neat facts for you. In 2013, Credit.com reported that 44.9% of all real estate purchased in America did not have a loan attached at the time of the close. What that means is 45% of homes or thereabout was purchased using cash. What does that mean? It means investors are buying real estate. Is the market bouncing back? Yep. Is it because homeowners are buying in? No. It's not because homeowners are buying homes and banks are giving loans to owner-occupants. It's because investors are buying real estate. Now, I pulled this article off the Atlanta Journal-Constitution. It was just a story about a family who made 80 trips to find a house. And what their problem was, every time they made an offer on a house, the hedge fund guy beat them to it. It gives you an idea of what it's like trying to find investment real estate. It's still extremely competitive, even though the market's bounced back. This just continues to go on and talk about the recession. I'm going to kind of skip through this in a little bit, but housing prices have started to recover, but the one thing that you need to know is many of the markets are still way below the previous peak, and I'm going to talk about one guy in particular. You probably know him. His name is Warren Buffett, and you probably know that in 2012, or you may know that in 2012, Warren Buffett purchased Prudential Real Estate. It's now called Berkshire Hathaway Home Services. This is a quote that he had made saying that if I had a way of buying a couple 100,000 single-family homes, I'd load up on them. It's an attractive asset class right now. You can buy them at distressed prices, find renters, you can leverage them. I think that that's as attractive as an investment as you can make. Now, this article went on to say the hedge funds have moved in, but Warren Buffett is not. He bought Prudential Real Estate. He bought Prudential for one solid reason. By owning Prudential, he has his own property management company nationwide. He also has the infrastructure. He also has an ability to sell the asset after he buys it. But for some reason, he's not jumped in. The smart money says he jumps in 2015. That's what most of the smart money says. And I get asked this question all the time. The market's rebounded. The large investors continue to buy. But what about me, the small investor? Did I miss the market? And I've been saying to people all year, no, I don't think so. I think that this is the best time for you to buy. And there's a lot of reasons for that. I'm not going to have time to get into today because I want to get to Michael. But there's a lot of reasons for that this is the best time to buy. And if you contact me or you join one of the webinars later in the month, we're going to talk about why this is going to be one of the best years to buy. And I also believe this will be the year, you can probably follow this on the internet, that Warren Buffett, Prudential Real Estate, is going to jump in. I've talked to one of their asset managers. He's based in Newport Beach, not far from me. For those of you that don't know, I'm in Fullerton, California, so I'm an Orange County person. By the way, the most overvalued real estate in the United States. Thank you very much here in Orange County. But down in South Orange County, Newport Beach is where they're one of their asset managers. And I did talk to him earlier in the year, and they weren't ready to buy yet, but clearly they were scoping out the market. And it always works the same with a hedge fund. They go in, they target a number of markets. They'll target, Birmingham, Atlanta, Chicago, Detroit, and Raleigh, North Carolina, just as an example. They'll target those markets. Then they'll come to people like me and say, okay, now who do I go to? Who's got the assets on the ground? Who can I buy direct from on the ground? And that's sort of how it always works out. And so the question for us this morning is, as a smaller investor getting into the market, how do you compete? We talked about the larger buyers, but how does a smaller investor compete? And I just said that I believe this is the best time to buy. And I'm going to give you some tips. By the way, these are not just my tips. This is really what most of the hedge funds use in terms of their buying criteria. But it does apply to you as well. If you're going to be in this market, if you're going to get into investment real estate, there's nothing wrong with learning from the guys that do it in a big way. So number one, number two, number three all go hand in hand. Number one, you have to buy below market value. You can't buy at market value. If you're going to buy in Orange County, you're going to buy at or above market value. That's not your best investment. There's plenty of markets in the United States to buy markets well under market value. You have to buy it direct from the selling party. What does that mean? When a hedge fund comes to me and says, I need to buy in the Kansas City market, the second question that they ask is going to be, are you direct? Are you working directly with the seller, the guy that owns the house, bought the house, fixed the house up, and is now selling the house? If the answer is not yes, they won't buy. You shouldn't either. If you're not buying directly from the selling party, if there's multiple layers of people getting paid, if there's double and triple escrows marking the property up, don't do it. Number three, don't buy anything that's not off market. If it's on the MLS, don't buy it. Once again, if I give a hedge fund a package, the first thing they do is they Google or they Zillow the property. If it's on the MLS, they're not interested. If it's on the MLS, you're not going to get the best deal. Number four, look for both year-on-year appreciation as well as ROI. What does that mean? It means you want to get a 10, 12, 13% rate of return annual. You also want to be in a market that's going up in value. So don't buy in a market like San Jose, California that's flatlined. You can get both. You should look for both. It may be out of state, but so what? There's good property management companies out there. It doesn't matter where it's at. It's like buying a stock. You don't care where the company's located. You care about the yield. Don't make it an emotional investment. Make an investment based upon numbers. Number five, make sure you've got infrastructure. Make sure you've got good property management. I could talk about that all day long. I plan on interviewing on both the radio show and the webinar of one of the larger property management companies in early January. It's critically important to success. Know your strategy, short and long term. If you're in it for a flip, know you want to do a flip. I don't recommend flips, but if you're going to do a flip, know you're doing a flip. Because what you're going to buy, what your strategy is determines what you're going to buy. So if you're going to do a flip, the personality of the property has to have a personality of a flip. Finally, only buy it fully rented and rehab. I have more people that still come to me and say, I'm buying this portfolio of 5 homes off this group, and they're getting started on the rehab on Thursday. I say, bad idea. Don't close escrow until it's done. And there's a lot of, I could talk about that for 15 minutes too. But I'm just telling you that's critically important to your success. Rented, rehab, turnkey equals low risk, high yield. Only buy it rented and rehab. These are the markets that we'll be focusing on in 2015. There's a lot of reasons why we're focusing on these markets that I don't have time to talk about today. We can do that offline or one-on-one. But these are the markets that we'll focus in. These are the markets that the hedge funds will be in start 2015. These are the markets where we'll focus our attention. There's a few markets here I like better than others. I love Birmingham. I love Memphis. I love Jackson. I love St. Louis and Kansas City. Those are great markets. I got hedge funds in all those markets. They're great for the smaller investor for a single 1, 2, 3 home purchase. Those are great markets with great infrastructure already in place. There are going to be some end-of-the-year deals. I took all these slides off to make room for Michael Gray this morning, and we're almost to Michael. But at the end of the year, you always find sellers looking to sell properties at deeply discounted rates. Most of these guys will have inventory on their books they want to get rid of for tax reasons. It happens every year. Most of you, or many of you, have probably seen some of my email blasts advertising some of the things that are deeply discounted. But if you contact me, I'm going to leave my number up here on the screen at the end of the webinar. Contact me. I can give you information on some of the things that are available now that you won't see prices like this again for a little while. Financed homes, I mentioned earlier, you can finance specific homes in certain markets. This home, for example, is in Jackson, brand new rehab property, down payment only $13,000. That comes out to a 35% cash-on-cash yield. I won't bore you with all the numbers for the sake of getting to Michael's presentation on taxes. All of our favorite subject, taxes, Michael. But contact me. There's all kinds of properties like this available now. So if you have a low amount of money sitting in a 401k or self-directed IRA and you want to buy real estate, start building your retirement portfolio type thing, contact us so we can give you some details. When I talk about rehab, this is what I'm talking about. This is what a house should look like when it's all done. It should look like it's brand new. And that's not just cosmetic, but that's including the plumbing, the electrical, all that sort of stuff. You want to work with wholesalers. The only people we work with is wholesalers that provide a turnkey product with a brand new lease, with a brand new rehab, and in many cases with a warranty of up to 1 year on everything in the property, which is pretty awesome as well. I featured this the other day. The price was lower down. This is the triplex in Birmingham. It was just finished last week. It's got a huge ROI. It was originally offered at $171. Now it's down to $162, so it's almost a 14% cap. So it's got a really big rate of return on that thing. It's brand new. If you look at the after pictures on this thing, everything in this house from top to bottom has been completely redone. It's beautiful. So I told a couple folks I'd feature that today, and I did come up with, the wholesaler did give me a discounted price for the webinar, which is $162.9. That's a 13.75 cap. I did the numbers this morning. It's something like a $22,000 per year rate of income on $162,000. So if you're looking for income, there's $22,000 a year sitting in that triplex. Okay, to Michael Gray. Michael, thanks for being here.
Good to be here. Thank you for inviting me.
Michael has written a number of books. His latest is the Real Estate Tax Handbook, something everybody should own if you're in the real estate business. Michael had some really good complimentary statements about the book. Ron LeGrand, who's the real estate investment teacher and author of The Millionaire Maker, said, finally a tax book written just for the real estate investor, and that is absolutely true. We've had a lot of great feedback from it, Michael. We're going to talk about how you can get a copy of the book. What we did was I took a number of topics that I think applies to the investor that typically shows up in these webinars or my radio show. So we picked, just sort of hand-picked a few topics that Michael's going to speak to, and just give you a little bit of information on each one, give you a flavor of what the book's about with regards to some of these topics. I didn't mention, yes, we're going to take questions. I already had a couple questions that came into the queue while I was talking. I haven't read them yet, but I see you got questions here. But if you look to the right of your screen, there's a dashboard there. And on that dashboard, there's a little button that says questions. If you type them in, I'll ask those questions, or answer those questions, I guess I should say, at the end of the webinar. I'm not going to open up the microphones. We have the largest turnout we've had here this morning in about 3 months. We have a really nice turnout for Michael. So I'm not going to open up the mics for fear that somebody may be doing the dishes in the background. And so I'm not going to do that, but I will take your questions at the end of the webinar. So with that, Michael, let's talk about 1031 tax-free exchange.
Okay. So obviously, whatever we talk about today, we're only going to be able to hit some real highlights. So a couple of things to just be aware of. Well, first of all, real estate is sort of a special type of an asset, and that is that when you sell it and you have a gain, and if it's investment real estate, then you can, in fact, just reinvest the proceeds into another property. And so that's really one of the key advantages of real estate right now. Also, that real estate has the most flexible definition of what is like kind. So you can only exchange like kind, but virtually any kind of real estate is like kind. So, for example, if you decide that you want to move from residential properties into commercial properties, that can be done through a 1031 exchange. So a couple of other, again, highlights, and then we'll have to move on. So one is that personal use assets. So, for example, your personal residence, of course, they have a special exclusion related to personal residence, but you can't exchange out of a residence in general or into a residence because those are personal use assets. They don't qualify for tax-deferred exchanges. The other thing is you have to watch cash and so forth. So if you have something called boot, for example, you receive, again, cash net from the sale. It's not all invested in the other property. You're going to have some taxable gain. Also, you have to watch the mortgage levels for the property. So if you're trading from a higher mortgage into a lower mortgage, even though all of the money is going into the other property, the decrease in the mortgage is considered to be cash. So I think that's probably the main points that I wanted to make about tax-free exchanges, and of course, invest in the book, folks. There's a lot more details there. Next slide, please. So the next thing we were going to talk about was deducting mortgage interest. So this is a confusing area for a lot of people. I think the main thing that I want to point out is just because there's a mortgage on a property doesn't mean that the interest on that mortgage is going to be deductible against that property. So a very common thing for real estate investors to do is to buy a property, maybe rehab or whatever, or maybe it just appreciates with time, and then they refinance that property, and they use the money to buy other property. So there are interest tracing rules in the Internal Revenue Code, and so what ends up happening is, maybe I should say, it's what is supposed to happen, because not all tax return preparers are diligent about this, but they should be, and that is that it may be that the mortgage that you have on one home is actually the interest on that is deductible against another home. Also, if you're just taking the money out for personal use, so in other words, now you refinance the property and then you get some cash and you use it to buy, let's say, your personal car or to take a vacation, the interest related to that portion of the mortgage is not deductible. That's personal interest, which is not tax deductible. So let's move on to the next slide. So family partnerships, this is an area where there's a lot of changes that are going on, partly because there's been really big changes in the estate tax laws in the last few years. The estate tax exemption now, I think this year it's about $5,340,000 per person, and so for a married couple, that's $10,680,000. That's a really big exemption, and so in the past, we were really focusing on trying to avoid the estate tax. The estate tax may not be as big of a problem for some people now. It sort of depends on the circumstances. So for those who are, the family partnership is a particularly attractive technique to use because you can get minority interest discounts. In other words, if I give a tenth of my family partnership to my children, the value that I put on the gift tax return is not 10% of the value of the property or whatever. It is going to be something less than that. Usually the discounts are coming out around like 40%. So if you have a lot of assets, the family partnership is really attractive. Another thing that it is good for is for shifting income among family members. So if you're in a higher tax bracket and your children are in lower tax brackets and you have properties that are in fact generating taxable income, this is a way of actually shifting income to your children, and of course then it's taxed to them at their lower tax rates. So again, all we can do is talk about highlights. Move on to the next slide, please. A really big development in the last couple of years is the net investment income tax. So some of you may have heard of this called the Obama tax. It's a 3.8% excise tax. It is not part of your regular income tax computation, although it is reported on your income tax return. An important thing to be aware of here is generally income from real estate is net investment income. And the way that the tax is computed is you compute your net investment income, and then you compute your income in excess of 3.8%. I assume that's of $250,000 for a married couple. Sorry. So the income in excess of $250,000, whichever is less, that's the amount you pay the net investment income tax for at 3.8%. Another thing to be aware of here is that if you are a real estate professional, if you can in fact qualify, then probably the income that you have from your real estate properties will not be subject to this net investment income tax. This is an incentive to be a real estate investor. Again, if you qualify, and it's hard to qualify, and the IRS is examining it, and they have like a whole group devoted to it, and mostly people are not succeeding in defending their position. So you have to spend more than half of your time related to real estate investment, and then usually you need to make an election to treat all of your properties as one property. So again, this is something you really need to consult with a tax professional about, but just be aware of that related to the net investment income tax. Because in the past, if we had income, we weren't that concerned about, whether you're a real estate professional or not. We were more concerned if you had losses, because then you were able to deduct the losses. That was not subject to the passive activity loss rules. Now we've got this net investment income tax. Brings a new element to the equation. Let's move on to the next slide. Okay, the IRS has issued a lot of regulations, new regulations related to repairs and capitalization. And so this is just something to be aware of. This is a reason, folks, that all of you, each and every one of you that's a real estate investor, should be seeing a tax professional this year. There are a change of accounting accounting method forms that need to be prepared related to this. There are new elections and other things. So there are some new safe harbors. There's a small taxpayer safe harbor where you can make an election that even if you would otherwise have to capitalize an expense, that means that otherwise you'd have to depreciate it. You can take a current write-off if the total of the expenses don't exceed the lesser of 2% of the unadjusted basis of the eligible building property, or $10,000, so whichever is less. And there are some annual elections that need to be made related to this. There are some new safe harbors for routine maintenance. There are improvements that are supposed to be capitalized, and the way that they describe them are betterments, restorations, or to adapt the property to a new or different use. Other than that, you have to get into the details. This is a complex area. The main thing for a lot of people is, when you rehab a property, you're going to be capitalizing almost all those costs and depreciating them. And of course, the depreciation life for residential real estate is 27.5 years. So sometimes there are studies that can be done to try to get shorter lives for some of the improvements. You need to have a pretty substantial investment in order to justify the expense of getting those studies done. I think we better move on to the next slide. Okay, and then the last area that we wanted to highlight is this idea of holding real estate in Roth accounts, Roth IRAs, retirement accounts. So the main thing to be aware of here, well, there's a couple, but why would you do it? The reason why you would do it is because for many of us, that's where our money is, and you can do it. It is an alternative investment that's available, and so it's something to think about. You need to be very careful here, though. There are special rules. So, for example, if you have financed real estate that's held in a retirement account, then there are unrelated business taxable income rules. Then an income tax return actually has to be prepared for the Roth or the retirement account, although for like corporate accounts, like profit sharing accounts and 401k accounts, they're actually exempt from that particular requirement. But for individual accounts like IRAs, they are subject to that rule. There is another thing, and that is that there are some people who flip properties. They're holding them very short term. when you have that type of a situation, it's a trader business, and again, the income is subject to income tax for the retirement account, and it pays pretty high tax rates pretty quickly, like 39.6%. So, so you need to be careful about it. This is one area where you need to really get really good advice, have good advisors that are looking over your shoulder. There is another thing that I want to mention, and that is that there are prohibited transaction rules here. And basically, you cannot touch any cash related to this property with your own hands. So I had a situation with a client that was an unhappy one. Unfortunately, they went ahead and they did some things and didn't talk to me in advance. So they bought some rental properties, and the renters paid them cash, and they took the cash themselves, and they used the cash for paying expenses for the property. That is a huge no-no. You cannot use currency. So you need to really, you should really use a property manager when you have real estate and you're using, holding it in a retirement account or in a Roth or an IRA account. So those are some of the main highlights that we wanted to talk about today. I cover a lot of other things in this book in detail, including talking about depreciation and rules related to the rules for your personal residence. So we have information here on how you can contact me. As Charlie said, we'll waive the fee for the first half hour for your consultation. The telephone number is 408-918-3161. That's my direct telephone number. I think Charlie is also going to send you the order form for the book, and the easiest way for us to handle it is if you would use that order form and then just fax it to us. And the books are actually at the printer right now. So, so as soon as we receive them, which I expect to be within a week or so, we will be shipping those out.
Michael, thanks so much for all of that. And I think the one thing that I came away from that, I've got some questions myself. Michael, we've already got questions in the queue, so we're going to take some questions now. But before I get to that, Michael said it a couple of times, and it's just so true. If you're going to invest in real estate, it's a really good idea to get your tax preparer or your accountant or your financial consultant involved in it. I've had a couple of financial consultants as my guests this past year. Ray Russo was on with me a couple times. Ray writes for Fox Business News. He was with us a couple times this past year talking about the tax benefits and talking about how you structure your retirement account. It's really important that you do that, and I really encourage you to consider purchasing Michael's book, $36.42 is the price. That includes shipping and handling. Yes, I have the order form. I'm going to send that out to everyone along with a copy of today's webinar, so I'll be sending that out sometime later on today. It takes a little while to download that from YouTube. When I get that done, I'll send it out to everybody. And so if you're, and a couple things, Michael, that there's a couple questions I want to ask you, and then there's one thing that I want to just a statement to make, and that is about holding real estate in your IRA, Roth IRA, or your retirement account, or buying it with using your 401k. We totaled this up a couple weeks ago. Of all the individual buyers that we dealt with in 2014, over half of them purchased using some sort of a retirement account or an IRA, whatever it was. But most of our business came through that vehicle. Now, for those of you that haven't been on our webinars before, we have done a number of webinars this year. I usually do one about every 2 months with Brian Davis with AccuPlan. If you're looking for information with regards to why you might use a 401k or your self-directed IRA to purchase real estate, if you contact me, I'll throw my information up here on the screen in a minute. Contact me, and I'll get you a copy of those webinars that we have done. We just did one with Brian about 4 weeks ago, and it was excellent. And Brian is a world of knowledge when it comes to 401k, self-directed IRAs, how it benefits you, how it works. I would really encourage you, if you have not been on one, if you get a hold of me, I get you a copy of one of those webinars you can listen into. Okay, a couple of questions, Michael, for you first. The question is, net investments tax, the Obama tax, Is that good for the investor? I think the answer probably is depends on the individual, but the question is that a good thing for the investor?
Well, it's not particularly a good thing for the investor because it means that we have to deal with another tax. And it's made our tax system much more complicated. And it can be a difficult tax to avoid. And the thing is that, well, let's see here. So let's say I had $1 million of income, of net investment income. That means I could have to pay a $38,000. Well, most of us don't have that much investment income. So let's say $100,000, 3.8%. That's $3,800. Well, anyway, the point is that the tax itself in absolute terms isn't all that big. And so, you know, if we knock ourselves out trying to avoid it, you know, it can cost us a lot more than that additional tax. So it's more of a nuisance in a sense than something to be terrified about. So, you know, so there are things that you can do to plan for it. And one of the important things, for example, is the state income tax. So that's a good tax deduction. The part that relates to the net investment income is deductible against that income. So you want to try to match that tax with the income by paying, for example, your final estimated tax payment by December 31st. So there's some planning things that you can do related to it, but like I said, you don't want to become all consumed about it because in relative terms, it's not huge.
Okay. All right. I got a question here in the queue. I'm going to put it in my own words. I know the person that's asking the question. She owns 3 rental properties in Birmingham, Alabama. She has, like most people, Michael, she has put a little bit of money into it for rehab, and she's had numerous expenses with regards to just the toilet backed up with $25 for a plumber, that sort of stuff. So the question she's asking is, are those deductible items? Are those business expenses she deducts?
Well, the answer is it depends. You have to get into the details of the circumstance. So, for example, you mentioned like a $20 plumbing expense. Okay, well, in most cases, if you have a situation where all of these little items are being paid as part of the rehabilitation process, then they might have to be capitalized. But once the property is rehabbed and you're renting it, okay, then that $20 plumbing expense is going to be tax deductible because it's a routine maintenance type of an expense.
Okay, so that got the question. The routine maintenance stuff is deductible.
For the most part.
Okay.
Yes.
Okay, there's a couple questions for me here that I'll answer real quickly. First one was, what markets do you prefer? You know what? I tell people all the time, first of all, when you analyze the market, the larger investor will always analyze it from a couple different perspectives. One being, what is the rates of return in that market, and what is the appreciation predicted to be in the coming years? You certainly want to be in one of those markets. All the markets I had on my screen there would fall into that category. St. Louis, Kansas City, Birmingham, Atlanta. Those are all markets where you get a good rate of return, and the markets are still well below the previous peaks. You can get great deals. You can watch your house appreciate over time. That's one factor. The other factors, 2 other factors that fit into that. You also have to make sure that you're in a market that you can get good inventory. If you don't get good inventory and you're not buying it below market value, then it's not a good deal. So that's the other part of it. Then the last part of it is you got to make sure you're in a market that you have good property management teams. So you have to combine those factors. When you are a hedge fund, you're typically going to have your own property management company, right? So you take care of that yourself. So they look for a market that's under market value, good inventory available, well below the previous peak. They put their own property management place in. Then the last component for them is, can they get good real inventory from the wholesalers on the ground? That's kind of the last piece. So you have to combine a number of factors to determine which markets that you would prefer. The ones that we have the most success in, clearly Atlanta, Birmingham, St. Louis, and Kansas City. Toledo, Ohio, I'm interviewing Angelo Remora from Toledo. He works Toledo and Dayton, Ohio, 2 markets that are considered to be the most undervalued in the nation. So those are some of the markets that we prefer, but it's because not just you can read on the internet the best 15 markets to invest. I mean, I read that yesterday, and MSNBC had a report the best 15 cities to invest in. You got to combine all of it. It can't just be the places where you expect it to have the greatest appreciation. You also have to have the best property managers and the best available inventory. So you got to have a little bit of everything blended up in a big bowl. Okay, what are the interest rates on the loans? They vary is the answer. If you buy one of the homes like it's $12,000 or $13,000 down that I showed on my screen, those are generally a 9% interest-only loan for 5 years, and there's a strategy how all that makes a lot of sense. I can share that with you. Contact me. My number's up here. I can tell you how that works. The groups like Security Pacific Mortgage, those guys are more like 4 and 5%. So they're like a typical 30-year loan, 4 or 5% interest, that sort of thing. So it's a little bit of it. So it just depends. It could be anywhere in the low side of 4 or 5% to the high side of maybe 10%. The good news is, though, is those interest rates a year ago for a non-recourse lender were in the teens, so 12, 13, 14, even 15%. So it's lower than it was. But yeah, sometimes in some cases for a $13,000 down payment, you're going to pay 9% interest only for a 5-year period of time, and the balance is due at 5 years. And how does that work? If you sell the property in 5 years, you've appreciated the property, you've made interest on the property over 5 years, so it's still a great rate of return, but it's about a 9% on the high side. There was one other one here. Let me find this real quick. What about investing in multifamily? Wow, great question. Okay, here's the answer. Multifamily can be a great investment. Multifamily is rare. If we don't know you're looking for a multifamily unit, you probably won't see them very often. Very rarely you're going to find those off-market available on the web or on Craigslist. You need to know somebody, because when they get a multifamily unit, even the triplex I showed, that's only a triplex, 3 units. Hard to get. We advertise them on these webinars. They never end up on Craigslist. They usually go to a client looking for a multifamily unit. So if you're looking for multifamily, contact me, give me your criteria, and I can probably help you. And it may not be right away. It may be a month or 2 or even longer than that. But if I know the criteria, I can be on the lookout for what you're looking for. The only other questions we have here in the queue are relating to the recorded webinar. I did notice we had 4 or 5 folks that got on sort of late, I think about halfway through. But don't worry about that. I'm going to send the recording out to everybody along with the order form to order the book. So you will get a copy of the webinar sometime later on today. And just let me look here again real quick. All right, we got another one here. Hang on one second. Okay, if you own rental property in an IRA, are expenses deductible? That's for you, Michael.
Well, everything is inside of the IRA, so it's not going to be deductible against your other income. And you'll need to be sure that, again, you're not paying those expenses personally. Everything should be, the property's held in the IRA, it should be with the IRA. So if you have a situation where some of the income is subject to the unrelated business tax, then those expenses may be deductible or a part of it against that income. So so that's the way that works. One thing to be aware of, again, I regard holding real estate in an IRA to be a little higher, it is higher risk than many other investments because of the nature of real estate. So I would segregate that into a separate IRA if I was investing in real estate in an IRA. If you've got other securities and other things that you've got, you want those to be separate in a separate account from your real estate IRA.
Okay, how about if you own rental property in a 401k off your personal income taxes?
What was that again?
Okay. How about if you own rental property in a 401k? Is there a way to write off expenses off your personal income taxes?
No. No. It's an expense of the 401k that holds the real estate, so it's not deductible against your personal income. And again, you don't want to be paying that personal. That could be a prohibited transaction. And if you have a prohibited transaction and it's an IRA, it disqualifies the IRA and it's all instantly taxable as of the first of the year, the disqualification. So this is, you want to handle this stuff very carefully when you're investing in real estate and retirement accounts. There's a little more leeway in the 401k type account or a corporate account. It may mean then, though, that you have to ask for an IRS waiver, and there's still a penalty that can apply. So just be very careful in handling real estate and retirement accounts, including IRAs and 401ks.
Let me point out there real quick, and I've learned this. I've been on so many webinars with Brian Davis with AccuPlan, and again, I'm not a professional, so. But one thing I can point out is simply this: when we do close a transaction with somebody buying something in their 401k or their self-directed IRA, they don't own it. The IRA owns it. The 401k owns it. They're the owner of it. And right. So the benefit of you, if you're trying to build a retirement account, long-term growth in an account, and you got $50,000 sitting in an IRA, for example, real estate's a great investment. $50,000 will buy you a single-family home in a number of markets across the country. That's a turnkey product that you get cash flow from. But all that money goes back into your IRA, right? And then if you have to fix the toilet when it gets stopped up and it costs $20, that really how that's done, and Michael touched on it, that's done by the property management company. And then what they do is they deduct that off the rent. So let's say you invest $60,000 or $50,000. A typical return on that would be around $650 to $700 a month. So every month that money is going back into your 401k, right? If there's a deduction for a plumbing issue, that comes off that income that month. You just get a net check. The net check still goes back to your 401k, and it just stays there. You just build that up and it accumulates over a period of time. Okay, Michael, next question back to you. Can you put a REIT, a real estate investment trust, or a TIC into a Roth IRA?
REITs are like a publicly traded security, and so there's no problem putting that in an IRA. A TIC, you probably can. Again, I would be very careful, and I would have people working with me in setting that up. But basically, what the idea of a tenants in common is that you have an undivided interest in the property. So it's like you own the property. There's a piece of the property in the retirement account. One thing you need to be careful about, though, is you have to watch the prohibited transaction rules and like who else owns that property. If they're family members and things like that, then that might create some difficulties. And again, who's using the property? So, and this applies even for a rental home. If you buy a rental home with the idea that it's going to be your vacation home, and you're going to use it, that's just not going to work. Or if you're buying a home and your child is going to live in it, or your parents are going to live in it, that is a prohibited transaction. So to be very careful about that. One thing, Charlie, that I think some of the properties, again, that you guys deal with are a lower cost, so that the retirement doesn't even need to borrow to buy the property. They could buy it outright. That avoids some of the problems that we were talking about related to the unrelated business tax when the property is not financed. So that's something to think about. Also, there are, again, we could do a whole hour or so related to this idea of investing in retirement accounts, but there are alternative investments. For example, having a private money mortgage held by the retirement account is a nice alternative. It avoids a lot of the complexities that you otherwise have for properties. The interest is just tax deferred, if you will, on the account, or if it's a Roth, it's tax exempt. So anyway, so that's another real estate alternative investment that you can think of.
Okay, I think that's it. And we got in right under an hour. We're 5 to 11. I want to thank everyone for being on today. If you're looking to contact me, that's my business number there, 714-312-0900. And contact me at my charlie.castro@sbcglobal.net account. I just realized that my email address for the radio show has changed to charlie@RERadio.live. I kept my old email address on there, so I apologize for that little snafu there. I just now discovered as I'm staring at my own screen. But it's charlie@RERadio.live.com or the SBC taxglobal.net. That's my personal account. So, okay. Hey, Michael, thanks for being here today. That was great information. I know everybody enjoyed that. I look forward to sending that out to all my folks in my database, which is pretty large. If you want to get on our mailing list, if you're not on our mailing list and you want to see what we have going on, we advertise typically a couple times a week. Contact me, and I'll put you in touch with my son, Matt. We'll get you into our database. We can send out information to you. Again, this was recorded this morning, so it will be going out to everybody. If you missed any part of it, it will be available on a YouTube video that we'll be sending out to everyone here in just a couple of short hours. So, Michael, thank you so much.
Okay.
And
you're welcome.
We'll look forward to visiting with you on the radio show next week. That's Real Estate Radio Live. If you want to listen to that again, you can go to kdow.biz on Thursdays from 2 to 3 o'clock, and you can listen in. My guest on Thursday will be Angela Remora of Ohio Cash Flow, a turnkey operator in the Ohio market, Toledo and Dayton specifically. So, again, I want to thank everybody. I left our numbers up here for quite a while, so if you need to get a hold of us, you know how to do that. Look forward to talking to you. I'm going to put Michael's number back up there again, 408-918-3161, mgray@taxtrimmers.com. Awesome guest today, Michael. Thanks so much for being here. I want to thank everyone for being here today. It was a great broadcast. Look forward to talking to you soon. Everybody have a blessed day. Look forward to talking to you.
Thank you.